Now, as we like to start off this segment, we like to look at the holistic picture prior to really starting to hone into specific products. And we just want to look at the aggregate, where are we across normal? And here you can see that we're coming up to that 2019 level when you look at that average. So again, that we're comparing the weekly numbers to the 4-week rolling average. But that's why when we look at the 4-week rolling average versus 2023 versus 2019, you can see that there's still that distance of about 1 million barrels between the two. And that's something that we think is going to be consistent. It will start to edge higher, but remember, it also does in 2017 through 2019 as well. You start to edge up. So as we're going to show you in the week-on-week numbers, in 17, 18, 19, there was all a spike almost exactly this week. So to see this increase is actually very normal when you look at the way gasoline is handled. And the way gasoline is handled is you have summer grade, you have winter grade. Typically, you try to get rid of as much of your winter grade as possible, and then you have a sizable buy ahead of what typically is what their cutoff will be is right around Memorial Day, which is not this weekend, but the following weekend. And so they try to get involved and try to move that through. So you did get a nice increase in gasoline, but it's something that has happened in 5 of the last 8 years, which obviously taking out 22, 21, and 20. So again, you're still seeing something that is fairly normal, but when you look at it in general, it's still below what should be happening this time of year. But again, we're also going into driving season. We're going into Memorial Day weekend. So it'll spike, it'll come down, but the trend is still going to be up, just at that slightly reduced level. And we're going to go through why we think that and where we're seeing some of that data points. When you look at distillate, there was a sizable draw of 4.17 million. That brings us 20.3 million below the 5-year average. When we look at the production side, production of distillate started to pick up a bit. You'll start to see some of those increases as we get some of that moving through. But there was also, as we also come into spring, into full spring, where you don't have the heating demand to the same degree. And then when you look at trucking, trucking had a nice little, shipping that had a little bit of a bounce, but now starting to continue that deterioration. We want to look at what does this mean. So typically, this was really a counter-seasonal draw. You can see going back through time, sometimes you have a draws that can go into the beginning of May, and then you start to see that baseline, and then it starts to increase. The question is always going to be, what about the rate of change? So imports, you can see 61,000 below the 5-year average. We don't see that really picking up in a meaningful way at the moment. The question is going to come down to, what are our exports doing? And that's where we get more concerned, because we see exports slowing as there's a significant amount of Russian products sitting in the water. There's now a significant amount of products sitting in Fujairah. And the question is going to be, how much of that comes in? Where are those flows going to go? And that's going to be the key one to watch. So we do see builds, but you can see we're so far below the average, there's still room to make up. So you could have a month of sizable builds and still be just at the 29-year average. So again, I'm not saying that, we're going to go with set new highs. No, we're still in a bullish backdrop. The question is going to be, what are refiners going to do? What crudes are they going to run? And where are those exports going to go? So we see exports being a struggle. We see, again, a lighter slate. And that's where we're going to see some of these builds increase, which is going to put some pressure on the crack spread over the next couple of months, realistically, not even just the next couple of weeks. But as we always say, nothing dies in a straight line. So when you look at cracks, like one of the things that we said is that $20 is kind of the line in the sand. If we break below 20, we're going to see some of those pressures to the refinery utilization rate. But again, it came straight down. You have a nice little bounce just because you got some movements. You might have had some decent crude come in that allows you to sell some of these things at a competitive market. But again, a bounce, and then we see a fade. But it's not going to be this straight break. It's going to be there's money to be made in some of these areas, especially in Pad 2 versus some of the in Pad 3. So, but there's also a lot of storage available in pad 3. So you could still see some of this increase, and some of these crack spreads kind of hold in a touch until we see a continuous drop. And again, it's gonna bounce. It's gonna come back down, probably take out that low, and then bounce around just above 20 until we start to see some of that rollover. And that'll typically happen. What we think is as you get into July, where you have that clear ramp of refinery activity. But as we get into the beginning of June, all of a sudden you have refiners starting to run up. You're not getting your exports that you expected on the distillate side. You're not getting the demand internally. That's going to put more in storage at a faster rate, which is going to pull this down. So that's kind of how we see diesel playing out over the next few months. Now, when we start looking at at the storage levels, you can see pad 1 still at a very low level. There's no easy way to bring this in because we can't bring in Russian product into pad 1. The Colonial pipeline is still tapped out, and mathematically, when you look at the ARB, it makes no sense to move diesel from the Gulf of Mexico into pad 1 or along the East Coast using Jones Act vessels, which again is going to keep things locked in pad 3, which is still kind of bouncing along the bottom. The problem is, as we get a bit of a cap on exports, that's when we start to see some of these things shift higher, specifically in pad 3. Now, again, demand had a nice little bounce. It's now above the 5-year average, but when we look at this on the trend basis, we still see this below the 5-year and really starting to struggle, not only just because of what's happening now, but also what is coming behind it. We did get a little bit of a bump in truck movements. As you can see here, had that little bit of a bump, kind of settling down. Now you're starting to curl over again. You're starting to see that slow once more. And when you look at the inbound ocean TEUs, you're starting to see that roll again. Right now, you can see that we're now falling back below 2019. And then here's a quote from Craig over at FreightWaves. Ocean container import markets are also giving way to sluggishness. Early signs of a container volume rally have faded as volumes have reverted back to 2019 levels. Now, when you look at that, it's like, okay, well, that's going to put pressure on trucking. But as we've been saying, it's putting a huge amount of pressure on intermodals. Intermodal took another leg down week on week from down 10% to down 12%. And we see that continuous drop. Now, total carloads flat week on week versus 2022. You had the grains, forest products slightly down, but again, tough comp. Petroleum products staying strong. Non-metallic minerals, motor vehicles, metallic ores, those are things that continue to move. But we see that starting to slow a bit after that catch up from the manufacturing PMI. So we do see total traffic continuing to slow. The intermodal is the thing that's the most concerning to us. That's where we see the biggest impact. And again, you're seeing it with trucking. You're seeing it with all these different flows in general. Then when we look even further back, not only just at the ocean which is going further, but kind of the intermediary, what is coming into the coast. Here you can see versus last year. Again, this is looking at the West Coast. You have things that are down 12%, 23%, 24% versus the previous year, versus the week on week. Again, just seeing that continuous slowdown, which is going to reduce diesel demand, which is going to reduce, what is happening in terms of movements, and showing how the economy continues to be sluggish, and it's going to pull down a lot of those demand figures. Now, we had a little bit of a reprieve in terms of the heat. Here you can see that things are fairly normal along the East Coast. So again, normal spring weather. Even if it's slightly below normal, no one's turning their heat on. Things are starting to warm up in the West Coast. Not to a point where you're going to see any type of a huge increase in air conditioning, but it's going to be interesting to see as things start to heat up. And if it heats up quickly, what is that going to mean for mudslides? There was a record amount of snowfall in a lot of these areas. What is that going to mean as things start to melt? And that's going to be an interesting one to pay attention to as we see some of those as we progress through May. Gasoline had that draw of 3.17 million. That's 16.1 million below the 5-year. When you look at it in general, only pad 3 is still above the 5-year average. you had pretty equal draws across the board. Pad 5 had a little bit larger, coming down 1.19. Now, when you look at blending components were down 2.57. So clearly there was a sizable move because blending components is confirming it. Some of the ethanol flows that we've seen are confirming it. So a lot of this is, again, connected to that pivot from winter to summer. It's just where is it going to continue? Because here you can see that, and again, coming back to that white line of 2019, we see some of this starting to increase over this time period, and you can get some counter seasonal builds, and it's going to be driven on imports. The question is going to be if we get imports. If we don't get imports to the degree I believe, then we're going to see a continued decline in storage. That is just the facts. I just see something a bit greater coming in on the import level. Gasoline imports were up 56,000 barrels a day. That's 52,000 above the 5-year. And it's all going to be based on what is coming from Europe into the U.S. Imports are at a 3-week high. We see that trending up. It's actually up year on year as well. It's up 157,000 barrels year on year. So again, we're starting to see that movement because prices have come down a bit. The ARB is reopened. Pad 1 is 9.7 million barrels a day below the 5-year average, more than enough space to bring and attract some of that in coming through. And Europe is at a seasonally adjusted near record high. The only time it was higher was in 2021, 2020. And only slightly, which we'll talk about in segment 3. So clearly there's enough to bring that pivot. And then as we start to get that spike and then fade in demand, not that demand is going to fade, it's just some of the numbers that the EIA is looking at is a bit artificially increased because it's a matter of when the gas stations are buying. That's kind of how they're looking at it. Where if you look at driving activity, TomTom is still showing us being about 10% below normal. You have Gas Buddy coming in at about 8.78 million barrels a day of demand versus the EIA at 9.3. So again, TomTom, Gas Buddy fairly close. That's why we're still at that 8.6, 8.7 million barrel a day view. That we will start to take that higher, especially as we go into Memorial Day weekend. We'll talk about that next week in terms of where things are setting up. And then we'll have that continuous increase in demand as we go forward. But again, when you look at that components level, the issue is going to be the chem side, because blending components, based on what they are, can go into the chem stream, can go into the gas stream. There is no saving grace in the chemical stream right now. So everything is going to get pivoted back into the blending component side, which is why if you look at that 2019 green, that white line, we think that things are going to kind of follow that trajectory at this point in time. And here's just, again, looking at some of those data points. We're not trying to make numbers up. That's not what we do here. You can see that when you look at the previous backdrops, like when you look at it in Asia, remember, had Golden Week. They had Labor Day. But it's actually trending below 2022. So you typically get kind of this wave effect. And the wave is you have a decline because of Eid, because of less activity from the fast, then you have a spike because of Eid, then you have that drop because of Labor Day, and then you start to kind of grind back up. But we're not really seeing that. We're seeing that pressure to the downside where it's actually 20% below normal, which is a sizable number. Europe is following a bit of a counter-seasonal trend versus last year where things are actually slowing. They're now 6% below what is normal. Then when you look at it on a week-on-week basis, when you look at the Labor Days, when you look at the U.S., we're also continuing to be at about a 6% decline versus the previous. But again, we get a little bit of that roll, then you get a bump as we go to Memorial Day, then you get some of that rolling over once again. So that's going to be an interesting one to follow as we go through the remainder of this year. And then when you, I should say the remainder of the summer, then according to Gas Buddy, U.S. gasoline consumption for the week of this previous week fell 0.7, but was 1.4% above the 4-week average, again, coming in at about 8.78 million barrels a day. So again, very much in line with kind of our thinking, but one of the things that I just wanted to call attention to on the Gas Buddy side is like, but is 1.4% above the 4-week average. That's going to continue because now we're trending up above because we should be setting the new week should be above the 4-week average as we run into the beginning of June. Then it kind of catches up with itself. And then as school ends, then you get that nice bump as we go into July 4th, which is, again, kind of the height of that travel period, which is something that we've been talking about. Now, gas prices have started to come down a bit. Diesel also coming down a bit. You can still see it's still well above that low point. And as you get some of the additional driving, some of that additional demand, you're going to see this kind of level off a bit. It's still going to trend to the downside. It's just the rate of change is going to be a bit softer. And that's something that is also going to impede some of that demand over the longer term. But again, it's just a matter of timing in terms of when does the consumer take that hit. Now, this is what we were talking about before when you look at the different cycles. So again, you get that spike, you get the fade, then you get that nice spike that normally happens some point before Memorial Day. As you pull through, as you've now sold out the rest of your winter grade, now you're refilling for the summer grade, which is going to pull in more blending components, a bit more, maintain your ethanol just to keep your RVP or reed vapor pressure ratios so that you can get some of those benefits. But you can see the previous years, you get the bounce and then the fade. It's something where we think is going to be continuous. 2 of the 4 years that we're looking at had a continuation of being elevated into Memorial Day and then dropped off. Just based on where we see demand right now, we don't think that's the case. It'll likely be a spike up and then a drop closer to about 8.5 and then trend back to kind of where we think things are. But will likely, by the time you kind of normalize it, it'll likely settle up closer to 8.7, 8.8, just based on that timing of how we see things going up. Because again, even though we see things at 8.6 to 8.7 million barrels a day right now, as the weeks go, you have to almost take it up 100,000 barrels a day every week until you get to kind of that stable point. You'll get a nice little spike, which will likely be an additional 250,000 barrels a day for Memorial Day weekend. Then you'll have that drop off, but it's not going to drop off to where we are today. It's going to drop below that 9 million mark and then start to trend back up and then cap out at what we think to be about 9.2, 9.3 million barrels a day. So essentially what we're saying is it's still going to go up. Like, we're not saying that gasoline demand isn't going to go higher. It's going to go higher. It's just not going to go to the same levels that it has been in previous years. Propylene had a build of 3.11 million barrels. 14.4 million over the 5-year. You can see it's still trending very high. This equates to a lot more supply, not a lot of chem demand. And again, just that's also, but it is going to make us an advantage buyer into the international market. So exports are still going to be very robust. And that's going to kind of put a floor in pricing, but it's because of the lack of internal demand, you're not going to get a lot of price appreciation. Just you're not going to go as low as we previously would have in level with demand levels like this. On the jet side, draws, storage came in at 1.72 million, a draw of 1.72 million. That's right around the 5-year. And you could see that there's that spike that normally happens. The question is always about when it happened here. So it will drop back down. We're still going to hold the demand levels of 1.45 to 1.55. But just like gasoline, as we go further and get closer to the Memorial Day push and beyond, again, we're going to have to move that up 50,000 barrels, essentially a week, until we get to kind of that steady state of, let's call it about 1.7 million barrels a day of that demand level. Here, when we look at it, globally speaking, the 12 weeks ahead is set to increase by 9.2% from the week starting May 2nd. That's China coming back. That's, again, that ramp up for the activity for summer. So nothing too crazy there. When you look at throughput, again, U.S. is pretty normal. You're continuing to see a little bit of that improvement from the Euro side. Still about 9%, 8% below normal, but again, closing the gap. And then when you look at the delays continue to hinder some of the capacity. But it's not like we're not losing 100 flights. It's just you're losing some of that incremental because of the issues that we've highlighted in previous episodes regarding the issues with personnel and keeping things moving at the airports. This is just looking at the 7-day moving average, taking out some of the noise. You can see very much holding towards 2019 levels. We don't see that changing up or down in any meaningful way. But an interesting thing here, we're continuing to see a slowdown in people eating out. So I think this is important because you're starting to see this bite more. And this is something that we talked about in February, where we started to see a bit of that pivot where people were like, had a bit of a sticker shock when they went out and like, oh my God, how much is that burger? Like, how much are these fries? And I think you're starting to now see that take hold, and that's going to draw down some of these numbers, which again, I think points to that breakdown that we've been talking about in consumer spending, which is going to be pervasive. I realistically through the summer months, which is why we do see summer underwhelming versus expectations, because I think this is showing you some of the breakdown of that consumption profile. So that's what we have for you today on this side. The next segment, we're going to go into the global flows, Russian production, and where we're seeing some of this refined product storage levels.